what are the trends in 2025 to ascertain trends in the future we can actually look at. 2024, the main narrative that I've seen from our customers is managing the expectations of their clients and that huge educational piece of what you can get for the budget that you have.
I think it's extremely important that whether you are starting out, you're a sophisticated investor or you're a buyer's agent, that you understand how to behave, act, and come across when dealing with an agent if you want priority.
Welcome to Property Banter by Pinnacle Buyers Agents. In this episode, we've got Dr. Matt from Htag. We're going to be discussing the 2025 market trends and metrics to watch. Hope you enjoy this episode. Please like, subscribe, and share with a friend. Let's go.
Welcome, Matt. How are you? Oh, here he is.
Good, mate. Glory, pardon the hat. As I said, I haven't had a haircut, so I look like a mess. As you've alluded to, better than a paper bag. So, nice to chat to you again, my friend.
Good to see you. Good to see you. Thank you for joining us. For those at home who have watched our podcast, Matt needs no introduction. He is, Matt, what's your title at Htag?
Head of research, I think.
Head of research and content creator and...
Well, I'm everywhere, but...
everything.
Most of my time is spent on either researching for others or providing feedback on others' research. That's why essentially it's that kind of.
And helping in the masterclass, helping do the masterclass that's coming up shortly, mate. Fantastic. Let's dive into this 2025 market trends. Kick it off. Let's go.
Yeah. So it's a good topic primarily because I think 2025 is going to be an interesting year. I think most of the big buyers agencies and mid-tier buyers agencies are positioning for substantial growth in their, I guess, both in their portfolio and their businesses. So there's going to be a lot more aggressiveness in the market, I believe, in 2025 than it was in 2024, which inadvertently disadvantages the little guy.
By the little guy, you mean?
I mean the everyday investor and buyers agents that are just starting off and building their business. Because if you have, I guess, my belief is, my take on this is, if you have more aggressive participation in purchasing, obviously that's driven by the amount of customers. But I do think that because of the macroeconomic shifts that are potentially going to happen in 2025, we might see a rate cut. I do believe that because the Perth wagon has, I guess, ended, Townsville is, still, pumping, and Cairns is pumping, but that soon will come to an end. And I think there's going to be a frantic scramble to find the next area, I guess, because of those multitude of factors. And speaking to large buyers agencies, middle buyers agencies, speaking to you, speaking to everyone on the ground, everyone is, every single direct message that I get from people is, Happy New Year. We are positioning for a great and major 2025. Let's go kind of thing. So I can see the sentiment there in the market. And because there's going to be more competition, that inadvertently disadvantages the little guy, i.e. the everyday investor. Now, the everyday investor, obviously those who are going to be assisted by buyers agents will not be disadvantaged, but inadvertently, if you're assisted by buyers agents that are just starting off their journey, do not have the networks established such as yourself, do not know how to communicate with sales agents or can't negotiate. When I say don't know, they're at their learning curve or learning journey on how to develop those skills. They're going to find it a bit difficult to source assets and to also anticipate these market trends or where they're going to buy next. So because of that sort of narrative that's happening, I think that knowing these trends is extremely important, first in communication with the clients and setting the expectations, because I think learnings from 2024, and that's going to lead me into what are the trends in 2025. Essentially, to ascertain trends in the future, we've got to look at the past, because that's the only time domain we can actually look at. So in 2024, I think the main narrative that I've seen from our customers is managing the expectations of their clients and that huge educational piece of what you can get for the budget that you have. So that managing the expectations, in order to manage the expectations appropriately, you need to know what trends are coming, what areas are going to grow most, what you need to look out for in a data set to pick the right areas. And that's a feedback loop, constant feedback loop between the market and you sort of setting the expectations of the client and going back and forth. And that's how the little guy wins. I think the little guy wins. I call him the little guy. I'm the little guy. I'm always on the side of the underdog, but The little guy wins by understanding what they need to look out for and what's proven as extremely fruitful in the past, especially in the last year, because what has happened in the last year? If we think about it, we came off a Perth boom that was lasting for a couple of years. Macroeconomically, we're also looking at a situation where rate increases have stopped. There was a discussion in the market about potential easing, which sort of, developed this positive sentiment. And I must say, surprisingly, well, not surprisingly, I wasn't surprised, but I think that a lot of people were surprised about the performance of some other areas and, the free fall kind of the nosedive into Cairns and Townsville, which is in some instances produced 40% growth in the last year, like Bold Plains, which is insane. So essentially a summary is, okay, how do we repeat that in 2025 and what are the trends that are shaping that and what everyone needs to look out for in order to I guess win in this game, because essentially, it's a competition.
It is a competition, but look, going back to that, little guy versus big guy, what the big guys are doing and the little guys and so on. The fact of the matter is, I think the market long term, the Australian property market as a whole, is moving towards representation on the buyer side. So whilst we sit here and talk about that little guy struggling to buy a property in an absolute boom market, that may be right now Townsville or Cairns, but just for everyone to know that when it's a boom market, everyone struggles. Doesn't matter who it is, because every buyer's agent has other buyer's agents that are competitors on the same level, whatever it may be, and everyone is looking for the same deal in the same place. And those 30 buyers are still, whether they're represented or not, going for that one property.
So would you say, to build on that, would you say potentially, and I don't know, I'm asking you because I think there's a skill set that's emerging that's essential to run a buyer's agency. Would you say that the big guys, and I have my thoughts on this, would you say that the big guys are the primary phone calls that are answered by sales agents?
The primary phone calls answered by sales agents are ones from buyer's agents who are confident, can do volume, and don't fuck around.
Yeah, so the big guys. I mean, some of those attributes, you can assume that they represent the big guys.
They could be mid-tier. I mean, I functioned really well as, buying 14 properties in 12 months and having the attention of the best agents before I was a buyer's agent. So it's the quality of the individual and how the individual comes across. The main thing is understanding the psychology of an agent when dealing with an agent. You need to understand what type of agent they are and pick that up, the psychology based on the phone call. Now, they could be the type of agent that's like, look, I'm going to run this for a few weeks. I'm going to try and get the best deal. They could be an agent that's a super high performer, and that agent being a super high performer is all about pumping deals. They want to do volume. So the least amount of time spent per deal is how they do more deals and in turn do their 100 or 150 or 200 per annum. So their goal is for a speedy deal that doesn't fall over. So you got to understand their psychology and how you come at them.
Absolutely. So now you've introduced another dimension, i.e. the skill of the potential individual, which is, I completely agree. My thoughts are, because big buyers agencies or mid-tier buyers agencies have volume, they have a presence, they don't fuck around I can't use a better word, in a sense that when they call someone in a particular area, they'll buy there and close a deal because they already have everything signed, deposits paid, etc. And that it's not ubiquitous in a sense that, every big player will have those relationships established. But surely big players, in order to get big, they need to service a larger volume of customers, which means that inadvertently they need to buy for the large volume of customers, which means that inadvertently they're closing large amount of deals and speaking to these agents. So absolutely. And then you've added another layer, which is just because you're big, it doesn't mean that you understand the psychology of the sales agent and that you will be closing the deal.
Yeah. And I've competed against buyer's agents who were buyer's agents at the time whilst I wasn't one, and I still came out on top. It's just it's coming in and not mucking around. This
is when it comes down to, because big buyers agencies would have a workforce.
Yes.
So you as an individual, when you were buying for yourself, and everything that you do for yourself. And even when you're running a business, if you're treating every service engagement as if you're doing it for yourself, you're going to build a great business. So you were buying it for yourself as opposed to the big buyers agencies who actually hire employees who potentially have other interests outside of there. They just want to pay their mortgage or the per day, and they don't have that drive and foresight that you would have as the individual. So yeah, that's definitely a negative.
100%. So when a lot of big buyers agents scale, they don't necessarily have teams that may have that skill set. So I think it's important for wherever you're at in your investing career, whether you are just buying your first home, you're a sophisticated investor, you are an entry-level buyer's agent, mid-tier, top, or just pumping the largest amount of volume, you need to know how to deal with agents. You need to know exactly what that agent's looking for, or the certain behavioral traits that you need to exhibit that agent's going to really gravitate towards.
Inspire confidence, yeah.
And I was very confident. I mean, when I bought my 14 properties in 12 months, I'd already bought and sold 8 properties before that.
So you bought 14 in 12 months, yeah?
Yeah. The goal was to only buy 4 or 5 that year, but I just ended up doing it really well. Under market value, growth market, high yield. We would do cosmetic renovations and get that equity uplift and so on. But I bought really well. I picked the agents. I knew which agents were selling stock that was value for money. I knew which agents were selling things that were below market value. I had studied that, and I built rapport with them so that they knew who I was. So when I bought, I was like, look, I'm ready to go. I'm cashed up, pre-approved. This is what I'm after. Let's go. When this pops up, I'm ready. I'll sign. And I remember beating, very, very well-known buyers agents at the time because of how serious I was and the fact that I built rapport. I didn't muck around. I went and signed the contract immediately, pay the deposit, move forward. But I had enough confidence in what I was doing because I had already bought and sold. So, and this is for those investors who are new to the game. They need to have someone with them that understands it if they're not confident. So, for example, I'll give you a quick story. I remember buying a property in Heckenberg, and I called the agent, and I knew that I was buying something that was very under market value. It was on for $279. I called the agent. I said, listen, I'm going to come down there. We're going to get the contract because every office has one printed contract in the office. So I said to him, grab that contract. What's the lowest price you can do? He goes, $260. I go, grab that contract. Don't let anyone touch it. I'm going to be there in 20 minutes. We'll sign it. I'll pay the 0.25 deposit. Then we'll go look at the property. All right? Because I already understand.
The fact that you know that they only have one hard copy contract is an interesting thing.
But that's because I spent time with agents asking these questions. So I was already, before we had the data we had today, I used to do things like, hey, Mr. Agent, what's your inquiry rate like? How many phone calls, inquiries did you have for the last month versus this month? So that's how I ascertain how hot the market is, how many people are showing up to the auctions and so on. So I was doing on-ground data, but I didn't realize it was data at the time. It's still data. Everything's data, right? So
absolutely. That's a great metric, by the way. I'll consider that.
You'll learn a thing or two, mate. Don't worry. So then I'd go look at the property. Now I understood that the 0.25 was what $700 or whatever it was. I figured it was $400, $700. I can't remember at the time, but I can't remember back to that time. But I'd sign it and I'd risk that 0.25% deposit. Why? Because I already know if I buy this for $260, I already know comps are at $330. Worst case, this is a post-war 3-bedroom, 1-bathroom. If I've got to gut this and renovate it, it's going to cost me between 25 and 30K. I already know that. Guess what it ended up costing me when I bought it? 26. Right? So I already knew this in my head before I went into the transaction, before anything. So when I called the agent, I called with confidence and I said, listen, take that contract. I'm going to come in, I'm going to sign it, and then we're going to look at it. So we went to look at it after I had signed the contract, whilst there was a bunch of people at the open house. And I said, and guess, and it was a bad open house because I had wallpaper all over it, and it definitely was an original home. The guy bought it for $8,000 in 1962 or whatever it was, and I had that original home. So there's a lot of work, right?
It's a replacement value element, yeah.
But I understood what it was going into the transaction. So funny thing is, looking back, that was an extremely confident buyer's agent style of a transaction. Well before that was my second property into that 14 property run, by the way. Oh, first property into that 14 in 12 months property run that I had in 2013. So, and that was December 2012. So I think it's extremely important that whether you are starting out, you're a sophisticated investor, or you're a buyer's agent, that you understand how to behave, act, and come across when dealing with an agent if you want priority.
Yeah, those are no, absolutely, absolutely. Those are the nuances that you either acquire through asking questions or through making mistakes. And it's there's a learning curve there. Or as you said, you get a professional on your side. The other side to that coin would be as well. Okay, where do I look at? Because as you mentioned, you will look at inquiry volumes as an indicator of market saturation. These days we have, sophisticated methods on how to actually anticipate and know these trends that are actually shaping the market. And as I said before, this is a good segue into what we're going to chat about. The best way to understand what's going to happen in the future is to look at the past. And the reason why, the last year is actually specific is because it actually relates more to the year that's coming forward macroeconomically than to years that were before that. And looking at the last year patterns, there are some interesting insights that I've derived about the trends that will continue, I believe, shaping purchasing in 2025. Some were surprising to me, others not so much. And I think there's about 10 things. We'll go through it one by one. I haven't counted them. I think there's about 10 things that really, really stood out in the last year. And the most, I guess, with data sets, and what is beautiful about data sets is that you're looking for that hidden gem. In the same way you're looking for that hidden gem in property selection, you're looking for that thing that usually you wouldn't actually look at. You would just dismiss it or bypass it, and you're trying to find these nuances in data sets that nobody can actually elicit or separate from the data upon which you can make a decision. And that gives you a competitive advantage. I guess to start off, I think the one surprising thing that I found in the last year is, and specifically because, most of the talk around the last year growth was centered around regional towns. Okay. And that's actually affirmed. If we look at the kilometers from the general post office, most of the areas in the top 100, if we look at the top 100 growth areas in the last year, most of the areas are located 140 kilometers away from the general post office. And that actually indicates regionality. That actually shows that most of the purchasing was in essentially regional towns. What is surprising, however, about that fact is that the average typical price for suburbs that have grown most, first 100 suburbs sorted by growth in the last year, the average typical price is 900K.
The average price is 900K. For property is 140K.
140K distance from the general post office.
Yeah, 900, because 900K for a large property is.
See, this is where the disconnect lies. It is the assumption, and this is what I used to say. So I've sort of proven myself wrong. I used to say, and that was actually a fact, by the way. I used to say that 9 out of 10 briefs that I received in the last year were in the sub 600K range. And I assumed by that kind of, sample size, and by the way, I speak to thousands of investors in the last year and buyer's agents. So there's a large sample size there, And I do, as I said, I do research for individuals as well as I check others' research and I look at their shortlists and provide feedback, as you know, in our mastermind. And most of the times you'll see, my budget is 650, 600 or below.
It's rare to see 700 and above. We never see 700 and above for investors.
That's right. No. So what does that tell you? That tells you that most of the demand was driven by owner occupiers in the last year.
That's true.
Which makes sense because the largest borrowing cohort in Australia is the owner occupiers, two times larger than investors, which inadvertently, when you're assessing an area, you need to make sure that there are ingredients there that are satisfactory for owner occupiers. The affordability indexes, the hold periods, renter to owners ratios, the livability aspect of the area. So the livability aspect of the area, I was just writing something down, just came to mind, which I'll address later. The livability aspect of the area seems to be one of the most important trends in shaping price growth in the last year. What did we do here now? Remember, we said it's a regional town. Most of the growth happened in regional locations. What is interesting is that the average typical price for those suburbs that have grown most, first 100 in the last year, was 900K. And I personally know that I mainly work with investors and buyers agents who buy for investors. Most of the ranges that I was getting was 650 to 600 and below, which means that most of the growth that was driven was by the owner-occupier cohort, which inadvertently implies that livability aspects of suburbs are the most crucial factors in decision-making.
Yep. And that's why we've seen 10% plus on owner-occupier style properties on the sunny coast.
Yeah. And by the way, the average growth for these first 100 suburbs, and by the way, 100 is a large number, was 26% in the last year. 26%.
Yeah. That's huge.
Okay. For what now sits at 900K typical value. So you can deduct the 26% from that and see where did it sit a year ago. If we do the calculations, so let's say, I'll just do the calculator. So if I go 900K, I'm just doing it as we speak, divided by 1.26. So we're talking about 700K, 715. So 715 was the driving range, which, remember, we did a podcast, the last podcast that we did, and I did the analysis and I said that the 700K typical value has the most potential to double in a decade.
Yes. I remember that.
So now this again coincides. It affirms our findings from the previous podcast.
Yes.
Okay. Yeah. Sorry. Did you want to say anything?
No, I was going to say properties, and when you jump into asset selection, buying properties with owner-occupier appeal matter so much. Like we've been doing in Cairns. We've been buying owner-occupier style properties in Cairns, in good parts of Cairns that have so much more room for growth and can go, from 600 to 800 because, people want to live there.
You taught me that a long time ago. There was another lady from Melbourne, buyer's agent, that said to me, shout out to Alexandra. She said to me, the best investment property is the one desired by owner-occupiers.
Yeah. Yeah, because they will pay with emotion. Yeah. They will pay with emotion, and they'll pay more because
the owner-occupier property, not only that, has certain characteristics that satisfies both cohorts.
Yes. Yeah.
I mean, the investor, you would always want to go for an owner-occupier property because it's spick and spam, essentially. It has all the attributes that are necessary for a family to live in there,
100%. If you don't want to do the work, if you plan on doing the work,
then it's exactly. This is purely a momentum thing,
Yeah.
Now, another surprising factor that I found is that the 10-year growth rate for all of these 100 suburbs that have seen most growth in the last year was 68%. It wasn't over 100, which indicates the importance of market cycles. So if something has grown more in the past, it will grow less in recent times, essentially. If something has grown, because usually an indicator of market stability that I used to use was, if an area has grown 100% in a decade or long periods of time, it has grown that much for a reason, which means there are fundamental and stability factors there, which allow it to grow that much. And we need to, when you're investing in a suburb long-term, you're always looking for stability and endurance factors. Now, the 10-year growth rate is a level 3 metric. And what I mean by that, it doesn't carry as high a significance than affordability index, which is a level 1 metric. But usually you do sometimes consider it as a stability and endurance factor. But what is this showing me is that in the last year, essentially, market cyclicality was more important. And the growth, the fact that an area, all of these 100 areas, if you average them out, they've seen only 68, but not only, but they haven't seen 10%, not accounting for compounding, they haven't seen 10% a year, and yet they've seen substantial growth in the last year. So it's flipping, you know what I mean? The less growth you see in the past, the more it's going to shift to the recent times and vice versa, okay? So why it's important to me is that when I'm assigning, and when I'm assigning value as index in our comparison module, I usually look at the 10-year growth rate as an endurance indicator. Now, 10-year growth rate is an endurance indicator. However, if your brief is to maximize return within the first couple of years, then you look at market cyclicality and you assign to lower values a higher significance than to higher values when it comes to 10-year growth returns. In order to ensure or increase the probability, all other things being equal, of recent growth, substantial recent growth. Does that make sense?
Yes.
Okay, so that's another thing. Now, one more thing that's been very interesting not very interesting. I mean, we've seen, and especially for Melbourne, we've seen a lot of talks about yield being an issue, bonds reducing. I'm getting emails from our customers, being worried about where the Victorian market is going and disadvantaging the actual owners in comparison to tenants. And, usually the articles are written in a doom and gloom factor because they need to sell. We all know that. But people are extremely concerned about this yield aspect. And what we've seen in December is because of seasonality and the end of the year, we've seen an uptick in vacancy rates predominantly across Victoria. Now, if you are going for a growth play, what is important to understand is that growth works inverse to yield. You will not see rents grow at the same pace and the same rate as the typical price. Usually one grows more than the other. So if the price grows more than, rents, yield lowers and vice versa. So that relationship is important to understand, especially when you're speaking to clients and setting expectations. And in doing so, you have to have a cutoff for yield and have to have, for example, a rule, which areas you will enter, what is your top yield. Like you usually, I'm not talking about the far left kind of understanding in a sense that, I want 7% yield and I want to invest in an 800K typical value property. You can't get that, You can't get that unless you put a large deposit. What I'm talking about more is with respect to these sophisticated investors who might be sidetracked with the media narratives. The average gross yield for all of these top 100 performers in the last year was 4%. Okay. It wasn't 5, it wasn't 6, it wasn't 7. It was 4. And that's gross, which means that net will be much smaller, which inadvertently shows that if you want growth, ladies and gentlemen, you got to compromise on the yield aspect.
Yeah. Would Sydney skew those figures a great deal?
Sorry?
Would Sydney skew those figures a great deal?
I've included the entire database across Australia. So I've included all of the top 100 performers across Australia. And I'll tell you now, looking at it, it's all WA and Queensland.
Yeah.
All. So there's not even one New South Wales or Victoria suburb, which makes sense because what we're going to see now, so it's 70%, 75% WA. The rest would be Queensland, maybe even 80% WA. The rest will be Queensland, which means that what's going to happen in the next year is that the Queensland will dominate that list, or at least it's going to be 50-50. You're going to see an increase in the Queensland suburbs and decrease in WA suburbs. Yeah? Which means that what you're looking at for Queensland, you're looking at the 700K typical values in Queensland for the next year. That should be the place where you're looking at. Now, the issue becomes we're talking about macro narratives here, trends, yeah? Now you have to hone in on the right suburbs, the 700K typical value in Queensland, and it's much less slim pickings than it is in WA, Victoria, and New South Wales because I've done the analysis. But if you hone in on that suburb, because we're seeing a shift in the market cycles and a migration from WA to Queensland, the number of suburbs that have seen substantial growth will grow in Queensland and reduce in WA. And the typical value that you have to hone in would be 700K with a 4% yield, gross yield, yeah? Is what we discussed. Now, one more, so what we talked about regionality, we talked about typical price, we talked about yield. Now, there's one thing specifically that I find very interesting. Now, you know that we have two proprietary metrics at Htag that were developed 3 months ago, I think, by Alex. There's GRC index and GRC minima. Now, GRC index measures the length of the number of months an area has spent in the positive growth zone throughout its entire life cycle. Like we go back to 2007, I think, for the GRC. So it is a stability indicator and endurance indicator. The less volatility that you see in a suburb, the more your long-term averages are. It's common sense. If the suburb booms, goes 20% and then declines 10% and then goes, that's a lot of volatility there. And that inadvertently lowers your long-term averages. Now, that is suitable for people who are timing the market. And that's another thing that I'd like to address, if you can remind me at the end. If people are timing the market and they want to enter and exit in 1, 2, or 3 years, then volatility is a very favorable aspect that you need to look at. And I would personally invest only in volatile areas, but I will make sure that I'm investing at the right time before it actually starts kicking and growing, because you want the pronounced volatility. You want the area to, behave in irregular ways. And this is how, people invest in equities and crypto, They time the volatility aspect to take advantage of it. Now, the average month that the area has spent in the positive growth zone, number of months that an area has spent in the positive growth zone. So the average, we're talking about GSE index, the average number of months the area has spent in the positive growth zone is 74 months since 2007, which is stable enough. But I usually, love to see even more stability and see, for example, and look at areas that have 100 months plus in the positive growth zone, which means they're more enduring, more stable, less volatile, which equals.
That would generally be your higher URSAD score, a superior school zone type of an area.
Many factors, but yes, what you delineated is two, long-term indicators, and yes, they would play a role. So I was actually surprised by the 74 number because I was expecting it to be above 100. That's one surprise, which inadvertently tells me that the areas that were in the top 100 were more volatile than what I would like them to be. Top 100, by the way, top 100 for growth in the last year, yeah? So more volatile than I would like them to be, which essentially reinforces the fact that I've only seen 64% growth in a decade. Less volatile areas would be the 100% growth and above, which would correspond to more number of months sitting in the positive growth zone. Does that make sense?
Yes.
Yeah. Now, the most surprising factor about that, so as soon as I saw the 74 number, I said to myself, okay, the areas were more volatile. But the most surprising factor is the GRC minima. And GRC minima talks about what is the lowest growth point that an area has seen throughout its duration of the growth cycle since 2007. And I was expecting to see minus 10, minus 15, minus 20 because I inferred volatility from GRC index, from the number of months it was in positive growth zone, because the number was lower. It was only minus 6%, because minus 6, not only, but it was minus 6%. Now, to give you perspective, the Gladstones, the Mackays have minus 15 or 20 at some points. So yes, these areas spent less in the positive growth zone than what I would like to see. But when they went in the negative growth zone, they didn't go down substantial. Yeah. So when you look at now, going back to Mackay is currently on hotspot, but Mackay is below the 700K typical value. Mackay potentially has bigger yield, and Mackay has much higher GRC minima, i.e. it spends much more in the negative growth zone than what we are seeing from the top 100 suburbs.
And these are areas that typically have more centralized industry.
Now, let's go to that. So first, before we go to that, I want to address another thing. The average URSAD was 6, which means very opportunistic. Well, not very opportunistic, but opportunistic. Okay? So 6 out of 10. So, which corresponds back to the price. And again, what I usually say to individuals that are filtering, if your price points are 700 and above, you need to eliminate the 1 and 2 URSADs. But it just seems that we also need to be closer to the 6 as opposed to 4 and 5. So you need to increase the appeal and the affluence of socioeconomics in a particular suburb in order to have those substantial gains. So what do we have? Typical price 700K, 26 average % growth, very regional, and yet the URSAD is extremely high. And by the way, the 10-year growth rate was lower than what I would like it to be. And the GRC minima, i.e. its volatility to the end point, needs to be also reduced, not passing the 6% mark, which is the average. Okay? So these are some of the things that are extremely important, extremely interesting to me. Now, the affordability index, another thing, and you jump in if you want to ask me questions, the affordability index for all of these areas is sitting at 40 years to own. Now, in my search, which affirms the ranges that we've preset on Htag. Now, this is not a surprise, but it's something that needs to be mentioned. So, as you know, different price points should have different ranges for URSAD. And if we are investing, between 550 and 750, 550 and 850K, the URSAD will usually be about 40-year mark, or should be about 40-year mark, in order to set the stage for growth. And now remember this. Remember how we said that the purchasing therefore was dominated by owner occupiers because of the individuals that I was speaking to who are mainly investors who are investing under 600, 650K. And this reinforces the importance of the affordability index. You need to have an area that is affordable for its internal residents, i.e. the owner occupiers, because it seems that they are the ones that are driving most growth around Australia. So this is why affordability index is one of the primary metrics that we consider. And also the range that we do assign is correct. So it needs to be about 40 years to own. By the way, yeah, the price point is 900K, which is actually, it was 700K if you take away the 26%. Yeah.
Yeah. 715.
Yeah. Now it's sitting at 40 years to own for the 900K, which means that it was sitting at an ERSAT of 35, let's say. I have to do the math, when it was at the 700K. So what are we triangulating now? We are saying buy in regional, buy 700K typical value, buy under socioeconomics that are extremely favorable, sitting at 6, and buy at an affordability index that makes it very affordable for its internal residents, sitting at 35. See, you've already layered 4 macro narratives that are extremely important and essential. Then you look at supply and demand and you're on a winner. Remember how we said if the little guy wants to win, these are the little nuance that you look in a data set. See, now you have 4 rules that you can essentially apply when you're filtering in a data set, and you can straight away exclude suburbs from your shortlist on the basis of these rules. And this is if you're looking to make the most money in the next year, i.e. 2025. These are the trends that need to be there for 2025. Now, we're talking about averages results for these metrics. Go below average. In the same way you will buy below typical price. Go below these averages. And then finally, if we look at these macro narratives, and that's why when I'm talking about trends, we're looking at macro narratives. You alluded to industry centralization. So the average industry diversification index is 71, which is opportunistic. Opportunistic is above 70. Which means that industry centralization is detrimental to growth. Or inverse it in another way, diversified industries are more positioned when everything else is aligned to perform in such a way, in such an exuberant way within a year. And which another layer to that, which I found surprising, as a little bit surprising, is that the lower risk score, and lower risk score, the RCS risk score, as you know, takes into account 80 metrics, one of which the industry diversification index, but then you have mining and agricultural dominance, flooding, bushfire exposure, renter-to-owner ratio, hold periods, all of these other livability aspects. The RCS risk score was sitting at 72. And you know that when I filter, I always say to people, make sure that when you're filtering for long-term investment opportunities, that your RCS score is set at greater than equal to 50. It just so seems, now I know from a correlation analysis we've done in-house that the risk RCS score is not a predictor of growth, it's just an insurance policy. However, even for short-term purchasing, you need to have this insurance policy. And not only should it be a greater than equal to 50, but you should aim for the suburbs that are sitting at a high 72 range or higher, because 72 is the average. So that means that there's a lot of suburbs there that had even a higher score for the RCS risk score. So as a recap, 900K typical value, which was 700K below, 26% in the last year. Regionality, 139 or 140 kilometers away from the general post office, dominated by owner-occupiers. The ERSAD must be high, sitting at 6% average or better. The affordability index needs to be considered. It can't traverse the 40 range. It needs to be very affordable, which coincides with the observation of, setting the stage right for the owner-occupiers. And your risk scores, industry centralization, mining and agriculture, exposure to negative environmental effects need to be considered even if you want to make exuberant amount of money in the short term. It's not just a long-term factor. It seems that the index should be sitting at a very high range of 72 or above, because that's where the 100 top suburb performance was sitting in the last year. And finally, by the way, one more thing that I like to mention, the infrastructure spending in all of those suburbs was sitting at an average $1,000 per person. That is astronomical.
That's really good. That is really good.
That is astronomical. And by the way, when I filter, and this is interesting, and again, databases evolve, and we need to evolve our rules. When I look at the decks and I assign significance for these price ranges that are higher, 700 to 900K, what I usually do is I say the school rank is more important than the infrastructure spending. So should I try attract a higher score? Now, it seems that infrastructure spending is also extremely, why the school rank is important, because it attracts the owner-occupier cohort, yeah? Now, it seems that the infrastructure spending is equally important, if not even a bit more. Because $1,000 per person is way above average. I mean, even if you have $300 per person, you're doing well. This is 1,000. This is 3 times.
That's huge.
That's 3x. So that's essentially what I've seen in the data set in the last year. And this is what as you know, Htag is going to be purchasing aggressively in the next year. And these are the factors that will shape our decision-making primarily in buying property in 2025.
Well, I love the insight. And 2025, we are all purchasing aggressively. It's one of those. It's one of those years where anyone who understands real estate and investment can truly see the opportunity. Matija, thank you so much for joining us today. We appreciate your time, and we will chat soon.
Pleasure, man. Thank you for inviting me again. Speak to you soon. Cheers.